So now we're going to be going more into details of the 5 internal control components. And the first component is the control environment. The control environment is considered to be the foundation for any kind of strong internal control system. So as it says here, the control environment is the overall attitude of management and employees about the importance of controls. There are 3 factors that influence companies' control environment, and these are management philosophy and operating style, the company's organizational structure, and the company's personnel policies. So let's start with the management philosophy and operating style. So management philosophy and operating style relates to whether management emphasizes the importance of internal controls. So you might join a company and you find that the senior executives or the senior management in the company, they really don't care into controls. They don't believe into controls. They think that if we have loyal employees and if people are honest, then this is all what we need. And that's not a very good attitude because, again, these kind of failures in the control happens because of overtrust sometimes. Another thing is the company's organizational structure. And here it says the business organizational structure is the framework for planning and controlling operations. And how the business is structured is also a very important element in the control environment, because if we have an organization where we don't have channels of authority and responsibilities, then everybody can do whatever they want to do, and there's no kind of authority or review or supervision that's taking place. And then the third factor affecting the control environment is the company's personnel policies. And this is anything related to human resources, starting with hiring people, firing people, explaining their duties, evaluating their duties. So the business personnel policies involve hiring, training, evaluation, compensation, and promotion of employees. In addition, job descriptions, employees' codes of ethics or the code of conduct, and conflict of interest policies are also part of the personnel policies. So here you can see that there's some kind of interrelationship between everything. So we have here the senior executives, they affect the organization structure, or they affect employees through the organization structure, and employees also have some kind of impact on their work through the personnel policies and the management philosophy and operating style. So all these kind of elements that we just talked about, or factors that we talked about for control environment, like the organization structure, personnel policies, management philosophy and operating style, they all have some kind of impact on the control effectiveness of the company. Now let's talk about risk assessment, which is the second element of internal control. And this is very important because we can never find control procedures unless we know what are the risks that we're exposed to. So think about someone who's locking their doors without knowing why we need to do that. So if I live in a neighborhood that is very safe, then maybe there's no risk of intruders. But if there's some kind of risk of intruders, then we better have like strong doors and strong security system. So the same idea here applies. So risk assessment, we have to assess what is the kind of risk we're exposed to. So all businesses face risks such as changes in customer requirements, competitive threats, regulatory changes, and changes in economic factors. Management should identify such risks, analyze their significance, assess their likelihood of occurring, and take any necessary actions to minimize them. And this is what we do when we are assessing risk. We want to know, what is this risk coming from? I always like to talk about risk assessment as 2 dimensions that we have to think about. The likelihood or the probability of something bad happening, and the magnitude of that thing. If it happens, how big it would be. So probability or likelihood, and the magnitude or the significance of that kind of risk. Now we have the control procedures, which is the reaction or the actions we take in terms of the risk of the risk assessment that we performed. So control procedures provide reasonable assurance that business goals would be achieved, including the prevention of fraud. So controls are maybe preventive or could be detective. If they're preventive, they're much stronger. We wish we can prevent fraud from happening, but at least we also need to have some kind of detection, or detection abilities, because if fraud happened and we fail to prevent it, at least we can detect it and correct it later on. So control procedures include the following. We need to have competent personnel, rotating duties, and mandatory vacations. This is very common in many businesses, especially in the financial field. So procedures should be established for properly training and supervising personnel. By rotating duties of accounting personnel and mandating vacations for all employees, employees are encouraged to follow these procedures. Also separating responsibilities of related operations. So the responsibility for related operations should be divided among 2 or more people. So they verify the work of each other. So this decreases the possibility of errors, simple errors or honest errors, and even fraud. Separating operating, custody of assets, and accounting duties. So by separating the responsibility of operations, custody of assets, or like holding assets, and accounting, the accounting records serve as an independent check on the operating managers and the employees who have custody of assets. And then we also need to have some kind of proofs and security measures. So proofs involve procedures such as authorization, approval, and reconciliation. Secure measures involve measures to safeguard assets, such as keeping cash on hand or in a cash register or safe. So here we can see the control threats, and we have management and business, and the control procedures are the things that would protect management and the business from these control threats. So things, again, to summarize them, remember these points, like competent personnel, rotating duties, mandatory vacations, separating responsibilities for related operations, separating operations, custody of assets, and accounting, proofs and security measures. All of these are different techniques for control procedures. Then we have monitoring, which is simply observing whether the system is working as intended or not, or if there's any kind of issue that's arising that we have to solve. So monitoring the internal control system is used to locate weaknesses and improve controls. Monitoring often includes observing employee behavior and the accounting system for indicators of control problems. So warning signs of internal control problems. I think this is interesting, especially like warning signs with regard to people, like change in lifestyle or abrupt change in lifestyle without winning the lottery. So you suddenly find one of the employees driving an extremely luxury car, or like spending money in a way that doesn't really match their income. Also, close social relationships with suppliers. Again, that's really a red flag. Refusing to take a vacation. And some people think, oh, if someone is loyal to their business or to their organization, they never take vacation. No, that's not true. Refusing to take a vacation is like whenever people are committing fraud, they want to make sure that nobody can discover their fraud, especially when they're out of the firm. Frequent borrowing from other employees. Again, this shows like some kind of pressure and need for money. Excessive use of alcohol or drugs. Again, that's another red flag that would send a signal that this person has some problems. Also, warning signs from the accounting system, something like missing documents or gaps in transaction numbers, unusual increase in customer refunds, like a lot of returns, or we're providing a lot of refund for customers. Again, this is something that we have to investigate, because in some cases it's not true. Differences between daily cash receipts and bank deposits, sudden increase in slow payments, or backlog in recording transactions. So they're not recording transaction as it happens, they wait, and this could possibly be an attempt to delay detection of fraud. The last component of internal control is information and communication, and I don't look at it as a separate component as much as a component that connects the other components together. So information about the control environment, risk assessment, control procedures, and monitoring is used by management for guiding operations and ensuring compliance with reporting, legal, and regulatory requirements. Management also uses external information to assess events and conditions that impact decision-making and external reporting. Now let's talk about limitations of internal controls. So internal controls, if we spend all the money we can, which is, by the way, could be expensive, still has some limitation. It's not going to be perfect. So internal control system can provide only reasonable assurance. It's not going to be absolute assurance. It's never going to provide a guarantee for safeguarding assets or processing accurate information and for complying with laws and regulations. And why we have this limitation is because of human element of controls, human errors. So we can have a perfect control, but because of human mistakes, then the control would fail, or the control procedure would fail. Or if there's collusion among people, so 2 or more people working against the control system, then they can make it fail. The other factor that prevents us from having a perfect internal control system is the cost-benefit consideration. Controls are expensive, and that's why we always weigh between the cost and the benefit. So I always use this silly example, like we all get insurance for our cars, and that's by the way, that's a control procedure, because if God forbids, like a car gets stolen or damaged, then we have insurance to cover that loss. But do we ever get insurance for our shoes? Unless it's a very expensive kind of shoes, which I don't know, like very few people would do that. But in general, this is something that we don't get insurance for because of the cost benefit. Like if I am wearing like a $20 or $30 pair of shoes, they really don't need insurance. If worst case scenario, if it got damaged, then I'll just replace it. But again, for another valuable items, we need to have insurance. So it's a cost-benefit kind of consideration. And in this case, in many cases, we don't want to spend too much time, money and resources for these kind of controls if we don't see the benefit out of these controls. So let me stop here. In the next video, we'll start talking about cache, and we'll get into more details about cache.